Hi, good afternoon, everyone. We'll just give it a few seconds just to let everybody connect, but I hope you're all having a nice day so far. And welcome to our event. Okay, as it's already a couple of minutes past, I think we'll dive straight in. So hi everyone, and welcome to this Economic Trends Forum. It's our first one of 2022, where I'm very delighted that today we'll be joined by our Chief Economist, Daniel Knapp. My name is Lauren Wakefield. I'm the Marketing and Industry Programmes Director at IAB Europe. And for those of you that maybe aren't familiar with the structure of our Economic Trends Forum, so we started this back in the beginning of 2020, and it was really set up to share market analysis and insights for our members. And then, as you can imagine, 2020, we had to shift our focus slightly and move things over to focus on COVID and the impact that has had on the economy and our industry. But we then continued the conversation through 2021, and then more recently dived into a few more specific topics. So looking at things like e-commerce, we shared the details of our ADEX 2020 report. And then at the end of the year, we had part one of this 2022 Outlook and Trends session. But today we're very excited to continue the conversation where we started with part two, to share some more predictions and market insights into what we can expect for the year ahead. Just before I hand over to Daniel to kick everything off, a little bit of housekeeping for everyone. So the event is live, so we do encourage you to share any questions that you have today for Daniel into the Q&A box, which you should be able to see at the bottom of your interface. We'll get to as many of them as we can at the end of Daniel's presentation. So do add those in, and we'll try and get through as many as possible. And then we are also recording this event. So we'll be sure to share this with everyone that's registered afterwards, so you can look back and dive into that as well. With that, Daniel, I'll hand over to you to share your presentation.
Thank you very much, Lauren, and a warm welcome, everybody. Those who have joined at the end of December will note that we started a prediction series to really understand where the European digital ad market is heading. And this was a two-part prediction series. In this first part, I shared information about how we see the macroeconomic environment changing as we are emerging from the COVID pandemic and what long-term structural factors are going to drive the digital advertising market forward in Europe in a healthy way. We identified a couple of factors such as continued demand from digital endemic players, the role of SMEs, and the continuing surge of e-commerce, although there might be some clouds on the horizon when it comes to ad prices and the sustainability of some of the e-commerce businesses that have been launched and have been contributors to the ad growth. But overall, the picture was optimistic and healthy. Now, as usual, with a generally optimistic picture, there are nuances, and there are high variations in terms of growth potential and also structural changes for specific parts of the digital advertising subsector. And this is something that I wanted to touch on in this second part of this prediction series to kind of help us shape a little bit more what we can expect in the next 10 months or so, as I believe these are all trends which will lay the foundation for how our industry is going to thrive within the next 5 years. What I'll do here in this presentation is focus on economic factors. So I'm not going to go into detail into regulatory issues or the whole looming privacy debate. I'll look at this briefly from an M&A perspective, but primarily from what's going to happen on the revenue side and what structural implications does that have for our sector. So without further ado, let's dive in. So these are really today is the second part of the series. How is the macro landscape impacting specific parts of our industry? Let's do a bit of a recap and look in the rearview mirror of what we have learned last time and what the learnings are from how to structure today's presentation. What really makes sense? I think what's pretty clear is that not only was 2021 a record year in terms of growth above historical averages, but we're going to see continued double-digit growth in 2022 and beyond. Today, I'm really focusing on what's going to happen in 2022, i.e. what drivers are behind these 14.4% of growth. And we can already see that this growth is going to be very, very unevenly distributed. So if we look at a market segmentation, and this is an advanced market segmentation here, some of these are fairly small and nascent formats like audio, retail media growing from a small base, but you can see a huge difference in terms of the growth potential. These are the various subsectors that I've broken out here. And I think there are a couple of criteria which help us to select which of these subsectors to focus on if we want to anticipate what's happening in our sector. And here are 4 sectors, 4 themes that I would like to dive in today, and I've attached the rationale for each behind each. Retail media, it moved from something very nascent to something that is already very sizable, which we expect to be already bigger than the overall CTV market, which is, at least in PR releases and in public imagination, captured a lot of mind share in our industry. So that's a key factor to look at. Also, when we look at the collision of privacy, data, and retailers as new publishers, agencies, and so forth. CTV is another important one, I think primarily due to the difference in adoption we see in European countries and what that means for the sustained growth rate of that sector. Social is, we used to treat this as a very monolithic category, driven in particular by Meta and some other smaller players. But I think there's an interesting combination here between the regulatory and other pressures that we can see, which are very apparent when we look at company earnings transcripts, and also the kind of nascent opportunity within the wider kind of social commerce space, which is going to be one ingredient of the often very elusive and ill-defined metaverse. So I'm not going to speak about the metaverse, but I'm going to speak about social commerce as one of the pillars of what that might be. And lastly, as with many market participants here involved in IAB Europe within the programmatic space, wanted to look a little bit at what kind of recent announcements within the programmatic space really mean for market disruption, and how, not just in the context of privacy, but also how players are structurally adapting to this. We need to kind of reimagine how this programmatic landscape is going to look like in the future. So these are going to be some thought starters for today. I'll go through each theme and then we're going to open it up for questions, and I look forward to you grilling me on some of those points. So let's dive into retail media first. Retail media is a core focus for us at IAB Europe. We have built an entirely new research program which throughout the year will provide new insights, analysis, benchmarking of retailers' offerings, market sizing, and so forth. So expect a lot on that space to come your way as you're joining our webinars and our wider publications. But here's some insights on how we believe the sector currently looks like and how it's going to evolve. There's fragmented data out there. The US data situation is a little bit better than in Europe, but I think this slide here really shows as a bellwether what potential there is in the market. On the left, you can see retail media ad revenue for some key players in the US, Walmart, Instacart, and Uber. It's always what the actual revenue was, retail media ad revenue in 2021, and then the companies themselves or commentators about the company, investors or ex-employees and others, were talking about in terms of what the business is going to expect. 2023 here is intentionally missing, as people were looking at either the next year or the next 2 or 3 years in their outlooks. And you can see the Walmart ad business, the company results were out a couple of days ago, now clocks in at $2.1 billion, expected to double in size to $4 billion in 2025. Clearly, outside of Amazon, one of the major players, with others, Kroger, Target, and so forth. But in particular, I think in the grocery segment, in the retail segment, these are key players. Instacart revenue, just their 2020 revenues of around 300 million USD. We expect it's going to be just shy of around 600 million in 2021, and they're expecting to be a $1 billion ad company in 2022. What's fascinating to see is kind of the musical chairs going around in this industry, as Instacart executive has been hired from Amazon, then from Facebook, and have moved back and so forth. So there's a lot of fluctuation. One of the things we're going to do in the future is to do an analysis via LinkedIn data to see where are companies poaching their employees from and what does that signal actually for the evolution of their offerings. Uber, also particularly driven by Uber Eats, is building its retail media ad revenue. Not all of that is going to be retail media, as the main Uber app we believe will also have ads in it. But it's a small ad business for US size of around 100 million, but going to go 10x to around 1 billion in 2024. Actual retail media ad revenue from companies in Europe is hard to come by. I shared previously our growth forecasts overall for retail media. We expect it to be, including Amazon, currently at around 9 billion euros in Europe, going to go up to around 28 by 2025. But there's growing evidence, in particular from e-commerce first companies, from grocery companies in Europe, which are starting to include mentions of retail media into their corporate filings. This is a quite remarkable development, given that, number one, Europe is around, we think, about 3 years behind the US. And of course, it's a much more fragmented market with many, many local champions. Number two, it's interesting because some of the kind of first retail media offerings were really built kind of in isolation, where, having spoken to a lot of grocery players in particular, it was hard to get C-suite attention and hard to get resources. But this is changing now as the CFO is looking at retail media and sees it as a core component of that business. Why? We're going to see that in a second. But here are two nuggets. Number one, Zalando had a great statement about kind of retail media subsumed into Zalando Marketing Services here, which saw above company average growth in the last few quarters. We can also see, we look at Sainsbury's with their Nect in the UK, with their Nectar profit center. We see that not only are billings growing of Nectar 360, which is the loyalty and retail media offerings, but also importantly, they see it as a key driver in profit contribution, i.e., always knew that retail media compared to selling groceries is a high margin business. A margin on bananas and cornflakes and so forth might be, ranging somewhere, depending on the retailer, but around 3 to 5%. Whereas here we can see a much higher a profit share, around kind of 80% when it comes to media. Now, advertising is a critical lever for retailers and their overall e-commerce profitability. For many grocery players, the grocery delivery isn't profitable yet, and retail media helps to make that bit more profitable. But I think it's particularly pronounced when we look at some of the last mile delivery company and look at the massive amount of volume raised by the right side here, some key players which we see in our streets in Europe, from Getir, from Turkey, Gorillas from Berlin. We have them across European cities. And this is running meme in the kind of e-commerce retailing sector about positive contribution margin, i.e., is this really a viable business to deliver groceries in 10 to 15 minutes, i.e., so a contribution margin, it strips away all the fixed costs from the balance sheet, the rental of the offices, of warehouse, bicycles, and so forth, and sees, if we remove all of that, actually, can we get cumulatively a profit for the orders that we have? And it's highly uncertain for many, although there are some signals that they might become profitable. But this kind of, again, shows how important a media and an ad offering is for the overall business model. It's not just an add-on, but it's an integral component to actually lift the entire company into profitability. This is why retail media is so important for many companies. You can see how slim actually overall retail margins are for many companies. So if you exclude the luxury segment, you got Kering, LVMH, and so forth. If you look at the right side here, you see many grocery groups in there, and you can really see that it's a low single-digit margin, making once it's sizable, really, really attractive for the CFO to see the retail media business growing and thriving. The most important thing, I think, is it's a very significant opportunity here outside of Amazon. We try to calculate out of the 31 billion USD, which Amazon's finally split out its overall ad segment, not anymore in the other segment, how much of that is actually going into Europe? And seeing if we take part of that as retail media, what is happening outside of Amazon? And is this one market or are these two markets? I think it's pretty clear these are many markets. So let's look at the left side of this slide first. And you can see that all are growing healthily. So Amazon in Europe probably around 55%, but others much more. And you saw this massive growth in overall retail media around 113% in 2021. We expect that it's not going to be a winner-takes-all market. There's significant room for European endemic players to thrive in this market. You can see this in our share of retail media ad spend 2020 between 2025. And often on panels, we're being asked, how should European retailers emulate the Amazon model? I think it's fundamentally the wrong question. And here are a couple of reasons on the right side of this slide in the chart why that's the case. Because Amazon and a grocery delivery company or a supermarket or online pharmacy can't really be compared. Number one, Amazon's revenue is highly reliant on its third-party marketplace. And this is mostly small businesses. So that's its ad business. So right now you can see it's a great article by in the US by a non-for-profit that talks about the Amazon toll road and saying that listing fees and ads, they are mandatory for goods to be sold on Amazon. And that kind of amounts to 35, 36% of actually the overall cost and profit breakout. Also, Amazon is highly reliant on Chinese sellers, in particular, small businesses or even large conglomerates who produce goods at scale for this third-party marketplace. And we expect around 30 to 40%, depending on the country, of Amazon ad business actually is bought from sellers in China, selling in the US, in Europe, and also in other non-China geographies. And we see who thrives on Amazon. Of course, Amazon has a self-serve model, but they're also specialist and highly niche agencies, young upstarts dedicated to that, which are really helping advertisers who are not self-serve to thrive and succeed on Amazon. But other retailers, we think of grocery or beauty and others, they have a very, very different client segment. So if you think of a Sephora or a Douglas, or if you think of your large supermarket, their advertisers, their trade budgets, where money is coming from, and also their digital ad budgets and their clients, they are large FMCGs, large beauty companies, luxury companies, so Fortune 500 advertisers, large advertisers. And they are highly reliant on big national and international brands, less so on China or other transnational spend. This also means that there's a strong opportunity for agencies or more in a sense, traditional holding companies to play a key role in working with retailers in building their offerings than is necessarily the case on Amazon. So we don't have one retail media market. We have at least two markets, and then we got specific dynamics for grocery, for beauty, and so forth. And the key message is there's a huge opportunity for us in Europe to develop this market with endemic players. We started to map and analyze the retail media offerings of different verticals in Europe. The one we've just completed is the grocery vertical. And we focused on the European big five markets, so UK, France, Italy, Spain, Germany, and also the Netherlands, as they're quite advanced in this, and looked at, do the grocery retailers, probably we got the kind of top 90% in terms of market share included here, do they have a retail media offerings? And those that have one, what are they offering? Is it a self-serve platform, or is it kind of managed service? And also, do they do more than sponsored listings? So over half already have a retail media offering in place. Some started very early, around 2016, 2017, but recently in the pandemic, rebooted this business. And other, when we look at launch dates, started their business end of 2020 or 2021. So lots of new activity happening at the tail end of the pandemic. At the same time, it shows there's still significant headroom for expansion, not just in terms of ad inventory on a specific retailer, but just from the addressable market. So there's still kind of a lot of retailers which need to come on board. And one thing that we're seeing is that large retailers who are more advanced, who have the capital resources, are starting to work with the smaller ones to, in a sense, like a third-party sales house, as we know it from the world of television, to aggregate this retail media inventory. So we're going to see within that retail segment, probably a few real powerhouses in Europe, maybe one or two per country, which are going to aggregate and run a lot of that. Of course, always with tech partners in our industry. Self-serve platforms is kind of a sign of maturity, which means that metrics and KPIs are clear. There's a UX, there's reporting in place and so forth. Often it is still fairly rudimentary, but we have to bear in mind that even the Amazon offering is still often fairly clunky and has lots of headroom for improvement. So nearly 40% have a self-serve platform. And then we said, let's include as a benchmark, as a maturity benchmark, off-site display. Because typically, retailers, well, they started back in the day with off-site display, but then, with on-site display, but then really moved into sponsored listings. So kind of, in a sense, emulating the Amazon model. And this is still kind of the predominant part of retail media ad inventory today. But increasingly, retailers are occupying a more strategic position where they're saying, we are not just providers of inventory, we are going beyond that. We are also offering our clients, the L'Oreals, the Kellogg's of the world, we're offering them the opportunity to use our data and the conversion data, our audience data and the consumer data, conversion data from our website to run off-site campaigns, i.e. buy media on their behalf and then track back, the kind of walled garden approach that we suggested, track back how conversions look like on their own page. Of course, massive opportunity right now, given changes in privacy and identity. And nearly half of the retailers, of the grocery retailers we have looked at in these 6 markets, actually already do that to a limited, to varying degrees. Some just do search. Others do also social commerce, which we come to a bit in a second. Some do programmatic. Others do kind of broader social on Facebook, Instagram, TikTok. So a huge array of different channels which they are using, but it's fairly unstandardized. And for the market to continue to grow in Europe, we need more of that standardization and also the ability to do that between different retailers. But overall, I think this shows, this chart, the strong vibrancy of the European landscape and the ability of European companies to innovate in that space. Now, let's come to connected TV, which is an important one as well. And we're already seeing, by the way, that some retailers are using their retail media data in the CTV space, but primarily in the US. So this is still a fairly self-contained area of growth in Europe, not being touched on by the retail media opportunity, but it will in the future. CTV growth in Europe, if we look at the chart, suggests the market is maturing very quickly. We all know that the CTV market for a long time has existed more in press releases in Europe than when we look at the actual balance sheets. It was primarily a US opportunity due to the particular market structure in the US with resellable inventory, MVPD, the rise of platforms like Roku and others. Now, we try to size the market and said, let's remove YouTube from the equation and just look at the remainder of the market, as the size of YouTube tends to skew the dynamics. We can see healthy growth throughout the pandemic in 2020, massive surge in 2021. But the important thing is continued high double-digit growth, well above 20% until 2024. So, but this isn't the case in all of the markets. So we're seeing very different deployment and maturity schedules when it comes to digital switchovers in some markets like Italy, for instance, which are propelling the market forward, easing regulations like in France. So whereas key markets like the UK, for instance, and to some extent Germany as well, will experience a slowdown into probably single digits of growth by 2025. Growth in the midterm is being fueled by large Southern European TV markets. Think of Spain or think of Italy in particular. The Nordics are kind of remarkably absent in the overall contribution to this growth, despite high wealth, high broadband connectivity, and mature TV markets, primarily because of the high SVOD penetration and the strong rights holder position of SVOD vendors in those markets, which so far has reduced the CTV growth opportunity. Overall, if we were to split things out between kind of what's currently going on in Europe in terms of broadcaster-led versus others, again, removing YouTube from the equation, we can see CTV remains and will continue to be a broadcaster-led market, but others, device UI advertising or kind of other AVOD services are going to obtain a growing share. We expect currently of around about 20% of the overall market, excluding YouTube, by 2025, with local variations in the markets. Interestingly, when we start looking into company earnings reports, that's another thing that we're doing systematically to see what are executives saying, what are kind of analysts probing about, we can see an interesting pattern. So here is Google. We looked at several terms: COVID, commerce, privacy, other things, Chrome subsumed into that, and TV. And remarkably, we can see heightened mentions of the TV opportunity, in particular in connection with YouTube, really starting in Q4 2020, and then kind of continuing that slump in Q3, but overall heightened talk about YouTube and acquiring TV budgets, brand ad budgets in particular, as privacy uncertainties and the maturing search markets harden the focus on this TV bit of the market. Social commerce, another growth area, I think that we need to contextualize a little bit, because social is experiencing quite a few headwinds. Again, if we do an analysis of company mentions, here is Meta, I think some very, very interesting patterns. We can see that very quickly mentions of COVID, both by executives and also by equity analysts, slowed down over the last year and are essentially non-existent right now. So where that companies weathered the COVID storm quite well, we can see something else come up quite starkly, and that's the term headwind. In different combinations, headwinds in terms of regulation, headwinds with regards to Apple's ATT, and so forth. So really, really strong exposure here. And Apple iOS we actually have put out separately. The metaverse, of course, occupies a kind of strong share of mind here, but also TikTok. And I think these two are really connected. In particular, when we look at the vertical video and the kind of social commerce opportunity. So, but we don't want to talk about the regulatory headwinds and how to mitigate them. I think the opportunity bit in here is the combination of the metaverse and TikTok mentions, which give us a little bit of a read through and on what can actually happen in the social commerce landscape. Social commerce, to understand it, we need to look at the Chinese market, as the Western markets, the US and Europe, are actually quite far behind. So for sense of scale and perspective, just look at this. So two major creators, big influences in China, Via and Austin Lee, during the recent Singles Day in, I believe, November, December 2021, within a 10-hour live streaming session, were able, via social platforms, to generate sales of 2.7 billion euros. Compare that to the Zalando revenue of overall 2020, which is around 8 billion. So significant explosion going on here. But to tap into this, it requires platforms, service providers, brands, retailers, influencers to all collaborate. And this ecosystem is currently just being built in the US and in Europe. And we're seeing heightened M&A activity in the sector with, in particular, I think over 50 deals and funding rounds in 2021 in the Western world alone. We can see how far we are behind China right now if we look at the digital ad market share in blue here. So global digital ad market share. How big is US, Europe, and China out of the total market? And what is the global social commerce share? So huge overexposure to China, and we are in the US and Europe far behind. However, the US and Europe are fairly close together, mainly because it's running over platforms, be it TikTok, be it Meta and others, where features are being rolled out kind of nearly concurrently or concurrently around the globe, in particular the Western world. And we're seeing we expect higher growth in this area. And we see a stronger correlation over time with the retail media opportunity, in particular, as retailers adopt further off-site display and off-site video strategies. Lastly, let me come to, I think, another year-defining and potentially era-defining phenomenon, which we can broadly call programmatic disruption. Programmatic we define as excluding social, so it's not just overall automation, but it's really everything transacted via the OpenRTB protocol, irrespective of transaction mechanisms. So whether it's open auction, private auction, programmatic guaranteed, programmatic direct. There was a unifying feature, both in terms of what these companies in that market were, the intermediaries, and also how they presented themselves as an option to the wider ad community, namely as the representatives of the open internet, funding publishers, going beyond walled gardens and so forth. However, if we're looking at changes in the privacy landscape and changes or challenges to underlying business models, we can see that at least when it comes to the openness of the programmatic pipes, there's a severe reduction going on, which has strategic implications, potentially even the need for consolidation among a lot of the programmatic industry. So overall, we're seeing massive M&A activity in that space. A few we've signaled here, first-party data and contextual in particular stand out. This isn't a complete list, but a snapshot of some, I think, important deals where we can see that different players in that world are trying to shore up their prospects in a highly uncertain regulatory environment. And we can see the same happening in the CTV space on the back of programmatic, and also in the mobile ecosystem consolidation, particularly spurred by the changes with Apple ATT and what's coming with Android right now. But we need to look beyond these deals to see what's actually happening in the programmatic pipes. And I think the signals are pretty clear. The programmatic ad spend moves towards more closed paths. We had DSPs and SSPs in the past, and everybody could at least potentially interact with each other. But a couple of market trends which signal that this programmatic world is becoming increasingly small and maybe will be relegated to the footnotes of history quite soon. You've all seen the Trade Desk announcement of Open Path, i.e. of a large or the largest kind of independent DSP building direct paths to premium publishers, connecting directly with their inventory, in a sense disintermediating other parts of the supply chain. However, this is just, I think, the latest iteration of what has already been going on. So if you look at the left side of the market here, we conducted an analysis of programmatic supply chains. This is data coming from the SSPs, from the reports, and from the APIs of 12 publishers within the UK and the European Union. Note, it's slightly biased because this is geared towards premium publishers, and we are excluding here the mid and the long tail of the market, where dynamics might be different. But what you can see on this chart here is how much of programmatic spend is actually happening within one's own ecosystem. I.e., we have 5 players here. They own a DSP and they own an SSP. And we looked at how much of the spend is going through entities that are both owned by these companies, i.e. What percentage of overall spend goes through company 1's DSP and company 1's SSP, company 2's DSP, company 2's SSP. You can already see that closed paths have been a key feature of the programmatic world. But with all the privacy changes that we have and other business model changes, we're going to see that widening further. And this means our analysis is going to mean that this is going to be quite a sizable hit to those who are only playing in one part of the ecosystem, in particular, the independent SSP market. So amidst this privacy innovation pressure, as we call it, closed path, onboarding first-party data, and other business model evolution, we're going to see the share of programmatic spend going via an open ecosystem, which we define here quite simply as DSP and SSP owned by different companies, is going down over time from currently around 40% of the market to around 25% of the market. This includes banner and video, but it excludes CTV, and it also excludes mobile ad networks, suggesting consolidation seems inevitable, and also doubling down on CTV and retail media, also not included in here, is key for SSPs to differentiate and for independents to make their mark. I think those were some of the key trends that we are seeing, which are set to define 22. This isn't a complete picture, but I think those are some of the puzzle pieces that are going to have most impact on how we see our European market evolve in the midterm. And with that, thank you very much for your attention. And I pass back to Lauren to moderate some questions. Thank you.
Thank you, Daniel. That was brilliant. So we had a few questions come up. If anyone else does have any more questions, do feel free to pop them in the Q&A box as we go through, and we can try and answer some of those as well. I guess if we start probably with some of the questions towards the beginning of your presentation, we'll talk a bit more about around retail media. Where do you think the budget's going to be coming from for retail media?
There are several buckets. Number one, there is the trade advertising budget. So this is something that typical ad spend studies don't actually incorporate. It's kind of seen as below the line advertising. So in a sense, featured products in the aisle, promotions in the supermarket, and so forth. That's a key market. Currently, in the data is very opaque on this, but recent Retail Week data suggests that in Europe, that's around a market of around 15 billion euros, probably a market of 50 or 55 billion globally. So a lot of that budget is going to come from there, and the budget that's going to grow. But again, that's primarily skewed towards groceries and some beauty products. Then there are new budgets coming in, which haven't been activated before, so entirely new money. And then it's money that comes from other parts of digital, right? So overall programmatic budgets, for instance, some social budgets we're going to see there as well. I think in particular about recent price inflation on social and others. So different pots of money coming in, but there's a problem in activating that money and to bring it together, because people responsible for these pockets of money are different. The trade advertising team within a FMCG is entirely disconnected from the digital team. The digital team, as we all know, might not even be integrated with the programmatic team, which means for a retailer and also for the agency, which I think has to play a critical role in this, helping the retailers, they need to speak to very different people. Lots of lunches to be gone to with different people to bring all this together. And that's the problem currently. Money comes from fragmented sources. And each of these pockets of money has its own KPIs and legacy measurement standards. And this needs to be brought together. Meaning, although we are very optimistic when it comes to the overall opportunities of size, footnote again, 28 billion euros, including Amazon in Europe by 2025, this isn't a self-starter. So a lot of work has to happen to really activate this budget. Because one thing we already hear from large advertisers like P&G is they say, retail media is quite expensive. You're charging, dear grocery retailer, you're charging a lot of money. And the CPMs are maybe 3, 4, 5x to what we see elsewhere. You need to deliver the goods. You need to improve measurement. We can't just going to have Excel reports, but we need something extremely granular to prove that return on investment. So of course, over time, CPMs will go down, and scale will grow, but measurement standardization, aligning look-back windows between different retailers. So when a conversion has happened and how that's being measured, that needs to be standardized. And I think that's also a huge task for national IABs, other industry bodies, and us at IAB Europe to help facilitate that conversation.
Yeah, definitely. And I guess you kind of mentioned there that having sort of standardization is one way of overcoming, I guess, some of these barriers to the kind of growth of retail media. Are there any kind of other barriers that you think are maybe could potentially hold back the retail media opportunity?
Quite a few interesting ones. So if we look at the US market, where of course you have players like Instacart, it's a weird frenemy situation right now, where there's a lot of co-opetition going on. So you have retailers advertising on Instacart, but they're also launching their own retail media offerings. So they are both competing with someone like Instacart and relying on them. And I think this is going to ruffle some feathers down the line, where we need to see how is this going to work. Other issues, I think, I already mentioned the measurement and the standardization is many different retailers, even if it's standardized, as an advertiser, you have to buy across them. How do you do that? There isn't currently a system in place. So you need the help of agencies. I think lots of analytics tools and self-serve kind of measurement tools will come into the market to facilitate that. But this orchestration across retailers will be critical. Lastly, I think we're seeing more and more retailers eyeing retail media. But the question is whether everybody really can build up the required infrastructure. Tech chops, the costs of it, of running it, the knowledge, of having that knowledge inside the organization. Remember, they're often very small still retail media organizations, which are at large, these companies are not ad native. They need to become more publisher-like and more agency-like, which is often very different from how the rest of the company is being run. So I think there's going to be a similar culture clash that need to be overcome in many retailers, as we're seeing in some of the consultancies that have moved from the blue suit and tie boardroom to the kind of sneakers and beard advertising world. So some of these things need to be resolved. Again, so not a self-starter.
Yeah. I'm just trying to see if there's any more kind of retail media based ones before we move on. But do continue to put any questions you have in the chat box. So obviously we talked also about CTV as well as retail media kind of being growth areas to kind of look at for this year. Are there any other areas that you didn't, I guess, include in your presentation that you think we should be at least thinking about outside of those that you perhaps maybe just thought to admit on this occasion, but are of interest?
I think there are plenty, and we need to reserve ammunition for future ETFs.
Definitely, yes. I can't give away everything in one session.
I want to focus on just a few. Of course, the audio space is quite exciting. The market is going to reach around probably 700, 800 million by the end of this year in Europe. It's small, so it's still kind of around 2% of overall digital ad spend in Europe, but it's growing quite quickly. You saw some kind of recent M&A from Spotify. I think there's going to be a bit of a platform competition. Spotify, YouTube, Apple Music, local radio players have started to build quite compelling programmatic offerings. So a lot is happening. A lot is happening in that space. Also, the move from in particular podcasting host-read ads to something more self-service. Measurement is improving, but it's a very complicated space that I think merits its own discussion.
Mm-hmm. Yeah, and somebody is also asking whether gaming and esports potentially came up as a growth area. I know we've spoken about this separately quite a bit, Daniel, as a kind of key growth area. So,
absolutely. I always want to have market data available before I comment on things, and we haven't systematically connected data on gaming yet. We're building that, but I don't like to speak anecdotally without having done the data analysis. But gaming is definitely an area that we will dedicate a separate ETF towards, in particular also in connection with the metaverse.
Mm-hmm. Yeah, that'd be super interesting to see how those kind of connect in the future for sure.
Yeah.
I guess looking more towards the kind of programmatic side of the presentation, so there's a couple of questions here, I think some just for clarity and some just in general. So should we expect more moves like OpenPath, and will it make SSPs redundant at some point, do you think?
I don't think SSPs as a category will necessarily become redundant, but there are a lot of Me Too offerings in the market right now. So I think first move is consolidation, which is inevitable. I think then what we're going to see is SSPs looking for other growth opportunities outside of the publisher realm to work, with retailers. Maybe Uber will acquire an SSP and so forth. So I think a lot of consolidation and then pickings from that world. But so that's one thing. And the other is, I think we've had a lot of these discussions about supply chain transparency in the past. Think of the PwC ISBA study, which is also captured an enormous share of mind. And in transparency and the complexity of these different paths, it's still a huge issue in programmatic. These consolidation moves will not make transparency obsolete, or transparency requirements obsolete, but it will fundamentally shift the transparency debate. Less from how much money is being lost in the middle between different intermediaries, but is the path proposed or superimposed to me, is that really the most viable one? Do I have all the costs available? And how do I optimize between different closed paths and channels? So I'm going to see a huge shift of the transparency debate. And I think it is a welcome shift, where some of that self-designed over complexity we've had in the market is going to go away. And one thing I'm also going to see in the transparency shift is that increasingly economic sustainability, does the money feed a publisher, how much money is being lost along the way, is being supplemented with discussions around the environmental sustainability of the supply chain, i.e. the carbon costs of ads, the costs of header bidding, duplication, quantification, and so forth, plus also the rendering and the streaming of ads. So this is going to be, I think, a huge area. Interestingly, so far, industry associations, agencies, and so forth have mainly covered that in the typical way with a declaration of intent and developing of standards and seals and nice landing pages, but not really by deploying technical solutions to make this better. The path compression is going to be part of that equation, but not everything. How the ads are being delivered is another key component. And look at Brian O'Kelly's kind of new startup, which
yes,
doubles down on this. But I think this is something that shouldn't be owned by a single company, but something that the industry must come together. So my appeal to everybody would be to move beyond statements of intent and kind of work together to actually develop standards and criteria that can be technically implemented to reduce the carbon footprint of ads. And that will, I think, move this very technical and often arcane debate that we've had within programmatic about SPO and supply chain transparency from an ad ops and tech CTO perspective to an advertiser CMO perspective, meaning that I think programmatic can have a greater mind share of the CMO's thinking than before.
Yeah, so it's all about collaboration.
But beyond the typical statements of intent, but by really actually doing something.
Yes, exactly. And then just a couple of clarification points, I think, from the audience. So somebody said, obviously super interesting presentation, thank you. Did I read it correctly that one of the SSP DSP combinations had 94% of their impressions running through their own pipes exclusively?
Yeah, so this was, by the way, this was spend, not impressions. And within that sample of 12 publishers, around 94% of programmatic spend that was going with one DSP, through one DSP, it went to its own SSP. Yeah.
Okay. And then there was just one more as well, I think it was just around clarification. So on the chart with social commerce versus digital ad market share across geographies, in Europe, the share of digital ad is higher than 50%, not 24%, is that right? Not sure if you can recall that slide off the top of your head.
A very specific question. Let me just double check. We're in here. Probably this one. Can you say the question again, Lauren? Then I can see.
Yeah, so it's on the chart of social commerce versus digital ad market share across geographies. In Europe, the share of digital ad is higher than 50%, not 24%. Is that right? I think it's just a bit of a clarification question.
Oh, sorry. This is not the digital ad share of total ad spend in Europe. This is Europe's share of the total global digital advertising market.
So that's the clarification I think that's needed. Brilliant, thank you. And I guess just one more question, unless anyone else has any more, please do pop them in the chat box. We've got a few minutes if there's anything else that we want to cover. So we talked a little bit around, I guess, first-party data being one of the points towards the end. Do you think that investments in first-party data lead to more money going into the walled gardens who actually perhaps hold a vast amount of first-party data themselves?
There are a lot of well-reasoned but contradictory opinions on what the future of first-party data really will be. I think we need to segment the market to understand its real value and its impact. So when we look at the, what we have historically called kind of the open internet, I think even some of the most kind of optimistic estimates say that look at publisher spend, right? Around 15% of users around will be logged in. So the vast majority of the web is going to be anonymous. I think that's one of the key facts that we must acknowledge.
Yeah.
Second is, I think when we work with first-party data as an industry, we need to stop our incrementalist thinking of trying to evolve the status quo a little bit forward. This is my personal opinion, but to really rethink how the entire system works from scratch, nuts and bolts and everything. And I think only then can we really use the potential of first-party data without always chasing regulatory headwinds. When it comes to first-party data, how is it being used? Different advertisers, very, very different approaches. And I think it's quite unfortunate that the ad industry, ad-funded publishers and intermediaries, agencies, they've shaped that debate, but advertisers haven't really leaned into that debate, haven't at large, and there are exceptions, but haven't at large contributed to resolving this. And we have some that are, in particular, those who have that are direct customer interactions, building up first-party data assets, which they are using or can most easily use, of course, on social platforms. But think of, I think, the rise of clean room solutions, or in the US, broadcast our partners with a clean room and so forth. I think that will make it easier to activate, but the actual value and scale of activation, I think, still is lagging a little bit. I think it's a very complex debate that has regulatory frameworks, that has kind of ideological perceptions of what's right or wrong, what should we be doing, questions of how that data is being onboarded and managed, whether something like a clean room is a two-party thing, is a multi-party thing. That's all open. So I think that again merits a separate discussion.
Yeah, lots of separate discussions we're going to be having on these very different topics. And then just one final question, I think, that's just come through. So when, in terms of CTV, when do you expect the measurement of CTV, impact data, etc., in Europe to reach the levels of US, if ever?
It will vary hugely by market. We're seeing not a pan-European approach to CTV, but very, very highly localized approaches. For instance, if we look at the UK broadcasters, very different to, for instance, HBB TV-led broadcasters in Germany, and HBB TV standards, or which version of HBB TV is being used, different from Germany than it is from Spain, for instance, but it's also being used. We've got still a legacy IPTV market in France. So these are going to be all local solutions. and not European ones. But I think what we must do from a European level is continue our work on defining what actually is CTV, what isn't CTV, provide cheat sheets and other instructions for buyers on how to navigate these national markets. And I think what's very good, what some broadcasters are doing is, it's still nascent, and in the past it was more, a kind of token office, but that's changing, is to provide ways of buying transnationally. And as we're seeing more collaboration, also consolidation in the European television market landscape, this is going to become easier. Also, of course, competition for broadcasters, but the rise of smart TV manufacturers and others is going to drive standards. But it's often platform-specific standards and not standards that adhere to, let's say, an entire market, like where someone like Barb or AGOV, AFG in Germany, or Mediametrie and others kind of used to collaborate.
Brilliant. Thank you. Well, I think we are just coming out of time. So thank you so much, Daniel, for sharing once again some amazing market insights for everyone today.
Thank you for your questions.
And if we didn't get a chance to get to anyone's questions, or if you do have any more questions, we are going to be sharing this recording with everybody that registered. So do feel free to drop us a note back, and we'll try and answer any questions that you have. If you are a member of IAB Europe, you're also entitled to have the slides from today's presentation. So do let us know if you'd like a copy of those. And we can also share the session recording and also the slides from the previous part one of this session as well. So do just reply to us with the follow-up, and we'll get back to you as soon as we can. But with that, everyone, enjoy the rest of your afternoon, and we look forward to seeing you in the sessions in the future. Thank you.